Dear professional students, you are welcome to another session of derivative valuation and analysis. In this session, we want to look at futures contracts. And to start with, what are futures? When we are talking of futures, futures are derivative financial contracts that obligate the parties to transact an asset at a predetermined future date and price. Here, what we are trying to say is that the buyer must purchase or sell the buyer must purchase or the seller must sell the underlying asset at a set price under future contract. The buyer must purchase is a compulsory. That is why we say that it obligates the party to transact an asset at a predetermined future date and price. So the buyer must purchase and the seller must sell the underlying asset at the set price regardless of the current market price at the expiration. And the underlying assets include the physical commodity or other financial instruments. Future contract details the quantity of the underlying asset and are standardized to facilitate the trading on the future exchange. Futures can be used for hedging and trade speculation. That is one by future. Now, what is future? Let's try to give a better explanation than what we just did. Futures, also called future contracts, allow the trader to lock in the price just as in case of forward that allow the trader to lock in the price. Future also allow the trader to lock in the price of the underlying asset or commodity. These contracts have expiration dates and set prices that are known upfront. So the future are identified by their expiration months. For example, we have a December gold future contract expires in December. The term future tends to represent the overall market. However, there are many types of future contracts available for trading. One, we have commodity futures such as crude oil, natural gas, corn, and wheat. Those are the underlying assets that will be in the futures and in the commodity futures. We also have stock index futures. And part of the index we have is S&P 500. We have German DAX, we have CAC 40, and the rest. That is for France. We have CAC 40. We have German DAX for Germany. We have AC 30 for Nigeria here. So these are the index we have. And not only that, we have currency futures, which include those for the euros and British pound. We also have precious metal futures for gold and silver. And we have US Treasury futures for bond and other products. These are the types of futures we have. It is also important to note the distinction between the options and futures contracts. Although we have not discussed option, but it's imperative we know the diff. Anyway, let's do it this way. We have not discussed option. We just discussed what? Futures. When I discuss option, I will try to tell you the difference between the three. Let's suspend discussion of difference or decision between the option and futures. Understand? But if I want to just brief it, I will tell you that the option contract gives the holder the right to buy or sell the underlying asset at expiration, while the holder of futures contract is obligated to fulfill the terms of the contract. Now, let's look at the advantage of this futures contract we are just discussing. When we are talking about advantage, we are talking about the pros. So, the investor can use futures contract to speculate on the direction of the price of an underlying asset. It can use to do what? To speculate. And not only that, company can hedge the price of their raw material or product. That means that the futures could be used to hedge. Understand? So the company can use to hedge their product or materials they sell in order to protect from adverse price movement. And aside this, futures contract may also require a deposit of a fraction of the contract amount with a broker. So it just requires only a fraction with the broker, which is known as margin. So that's the advantage. What are the disadvantages? When we are talking of disadvantages of futures contracts, the first one is that investors have risk that they can lose more than the initial margin amount since the future use a leverage. That is one. Two, investing in futures contracts might cause a company to edge, the company that edge to miss out of favorable price movement. It is true, but when you edge, you have locked in the price, and if the price outshoot the level you edge it, you will not be able to take the advantage. You only get the level which you have locked it. And the last disadvantage is that margin can be double-edged sword, meaning that gain and amplify, and also losses will also be amplified. These are the usage of what? Sorry, the pros and cons of edging. Now let's look at the use of edging. Sorry, the using of futures. When I'm talking of using of futures market typically use high leverage. Futures market typically use what? High leverage. High leverage means that the trader does not need to put up 100% of the contract value amount when entering into the contract. Instead, the broker will require an initial margin amount, and which consists a fraction of the total contract value. So the amount held by the broker can vary depending on the size of the contract, and also it depends on the creditworthiness of the investor and the broker's terms and conditions. Those are the things that determine what the edge will be. Now, we are still under the using of futures. The exchange where the futures contract will determine if the contract is for physical delivery. We have some contracts that are physical what? Physical delivery. So when we are talking of physical delivery is where the asset supposed to deliver physically, and it could also be cash settled. It could be cash settled. Now, a corporation may enter into physical delivery contract to lock in the price of the commodity they need for production. However, most futures contracts are from traders who speculate on the edge. So these contracts are closed out or netted, and the difference in the original trade and closing trade price is what we know as cash settled. Now, let's remember earlier I said you can use futures to either speculate or hedge. Let's see how we use the futures to speculate. We are talking of future speculation. A future contract allows a trader to speculate on the direction of the movement of the commodities price. And how does this happen? It happens in the sense that if a trader bought a futures contract and the price of the commodity rose and was trading above the original contract price at expiration, then they will have a profit. They will have a profit, right? Now, before expiration, the buy trade, which indicates long position, will be offset or wound with a sell trade for the same amount at the contract price, effectively closing the long position. So the difference between the price of the two contracts will be cash settled. Will be cash settled in the investor brokerage account, and no physical product will exchange hands. However, the trader will also lose if the commodity price was lower than the purchase price specified in the contract, or in the futures contract rather. Now, speculators can also take short position or sell speculative position if they predict that the price of the commodity asset will fall. So that's where they take short position, and short position indicate that they want to deliver asset. And if the price does decline as expected, the trader will take an offsetting position to close the contract. And again, the net difference between the settled at the expiration of the contract and investor will realize again if the underlying asset price was actually below the contract price, and a loss if the contract price was above the contract if the contract price was above, if the current price rather, if the current price was above the contract price. And it is important to note here that trading on margin allows for much larger position than the amount held by the brokerage account. As a result, margin investing can amplify gains, but it can also magnify losses. Imagine a trader who has 5,000 broker account of $5,000 broker account balance and is trading for a 50,000 position in crude oil. So the price of the oil move against the trader, they can incur losses that are far exceed the brokerage account, which is a $5,000 initial margin amount. In this case, the broker will make a margin call requiring additional fund be deposited to cover the market losses. That is how speculation actually operates. Now, the next one is futures hedging. Futures hedging futures can be used to hedge price movement as well from the point of the short position or from the point of both the manufacturer and the buyers. So future, as I said, can be used to hedge the price movement of the underlying asset. Here, what actually happened is that the goal is to prevent the losses from potentially unfavorable price change rather than to speculate. And many companies that enter hedges are using or in many cases producing the underlying asset. For example, a corn farmer can use futures to lock in the specific price for selling their corn crops. By doing so, they reduce the risk and guarantee that they will receive the fixed price at their at the time they are getting the produce from their farm. And if the price of the corn decreases, the company will have a gain on the edge to offset the losses from selling the corn at the market. With such a gain and losses offsetting each other, the edge effectively locks in an acceptable market price. So that's that. And when I'm talking of regulation or how do future contract work, so we want to look at the perspective of what regulation of futures. The futures market are actually regulated by Commodity Futures Trading Commissions, and this was a federal agency created in 1974 to ensure the integrity of futures contract or futures market pricing, including preventing abusive trade practice, fraud, and regulating brokerage firms engaging in futures trading. So that is a little regarding futures contracts and the futures market. So with this, we had already opened your mind regarding that, which we believe you can also build on. Thanks for listening.